We're talking about mortgage rates, McDonald's E. coli outbreak, and global liquidity crisis. Hey everyone, welcome back to Learn Wealthy. I was in LA this weekend. Well, I was busy, so here's your Monday market update on a Tuesday. I apologize. It doesn't happen a lot, but let's jump right away in what's really moving the markets right now. So remember when people said mortgage rates would come down because the Fed just cut rates by 50 basis points. Yeah, not so much. The 30-year fixed mortgage rate is holding strong at around 7%, and it's not because of the Fed funds rate. It's all about the 10-year Treasury, as I've said in this previous video. The 10-year is hovering at around 4.3%, and it looks like the 10-year Treasury yield is trending up. So you can expect the 30-year mortgage rate to trend up, since it basically mirrors the 10-year Treasury historically. Again, we're only playing with probabilities by looking at historical data. Basically, unless the 10-year Treasury yield drops, mortgage rates are staying up there. And for a lot of home buyers, that's a big hit. And if you've been watching this channel, I told you that supply is increasing and home buyer demand is extremely low. And it looks like we're headed for a buyer's market. McDonald's E. coli outbreak. Now let's talk about McDonald's. They're dealing with an E. coli outbreak that's all over the news. With Q3 earnings around the corner, this could hurt. McDonald's stock slid about 2% last week as this story broke. And here's why it's a big deal. Outbreaks like this can shake consumer trust. And with McDonald's customer base, even a small shift in consumer confidence can mean millions lost in revenue. And the revenues have already been suffering and taken a hit with this high inflation. Analysts are keeping an eye on this one. And wouldn't be surprised if we see some cautious forecasts for the next earnings. If consumer visits dip, we'll see it reflected in the numbers. China's real estate crisis and global liquidity squeeze. All right, this one's huge. China's real estate crisis is hitting harder than ever. We're talking major defaults from giants like Evergrande and Country Garden. And now there's a looming serious liquidity crunch. This has global implications. China demand for raw materials is cooling, and it's starting to affect global markets. Take iron ore, for example. Prices have dropped 5% in the last month, and that's just one piece of the puzzle. We're also seeing central banks tighten policies as they try to maintain economic stability, but higher rates are making borrowing expensive across the board. In short, liquidity is getting tight worldwide, and that's a problem for economies and businesses alike. Gold price is on the rise. Now let's talk about gold. Gold is back in the spotlight as investors look for safe havens amid all the economic uncertainty. Prices are sitting at around $2,750 per ounce. That's an increase as more people hedge against inflation, even though historically, gold prices have a poor correlation with inflation. I think gold is more related to currency and systemic uncertainties. If we continue to see global instability, we could see gold prices go higher. So there you have it. That's your Monday market update for this week. Thanks for sticking with me, even though we're a day late. The market is shifting fast, and it's always good to stay in the know. And as always, hit that subscribe button if you haven't yet. For more finance, investing, real estate, and macroeconomics, let's all learn wealthy together. I'll see you in the next video.